Felix here. The Fed has just published a research paper, all 31 pages of doom and gloom. What's it all about? Well, they're running you through some numbers and giving you a very dire warning about stocks underperforming into the next decade. And this isn't actually gobbledygook. Yes, it's contrived, but it's probably true. Let me run you through what it says, what the numbers are, and what we can actually do to make money regardless. And on the note of making money regardless, we're giving away our level 2 stock course. It's usually $1,500. It's 99% off. Why? Because we're celebrating 50,000 subscribers. So thank you for building this community of people who want to get financially free and are not too shy to ask for help. So the numbers, all right. 1947 to 1989, GDP grew 7.6% on average, but let's call it 7%. Stocks earnings grew 7% on average, slightly less than GDP, because the economy grew, stocks grew slightly less, earnings grew slightly less, profits of companies. Now, 1989 onwards, what happened? Well, GDP growth halved, almost 4-point-something%, and earnings, profits growth of listed companies went to 7.7%, so it increased. How is that possible, and why does this mean that it isn't going to be possible going forward, according to the Fed? Well, they cut taxes. Significant tax cuts occurred since 1989. Just looking at the numbers here. So 40% of all profit increases at US listed companies came from two things since 1989: tax cuts and lower interest rates. So what they can do is they can take on more debt, but because the debt is so cheap, it's easy to service it, and that allows them to leverage. At the same time, they pay very little corporate tax. Lobbying works. I've always said it. The brown envelope job under the table still works to this day. And, well, corporate rates, tax rates are pretty low in the US, fairly unlikely that they're going to go much lower. Now, interest rates, according to the Fed, are also not going to go much lower, certainly not lower than the 0% that we had pre-COVID. So they're saying to sustain this level of earnings growth, and let's face it, stocks in the long term are all about earnings growth. Okay, in the short term, it's, AI and this thing and that noise and whatever. Short term is a different story, which is one of the reasons I like trading the short term. But for my long-term stock portfolio, for your long-term stock portfolio, profits and profit growth matters the most. And essentially, they're running us through some numbers here. For example, McDonald's, as an example. If they had to pay the old interest rates and the old tax rates, well, what would have happened? Well, effectively, it'd be worth about half. Pepsi would be worth about 60% less. Clorox would be worth 37% less, just to give you some ideas. So income growth for companies like McDonald's and Pepsi and other large US companies has been very significantly, about 40%, due to lower interest rates and lower tax. Not going to get lower taxes, you're not going to get lower interest rates, according to the Muppets at the Fed. So what should you therefore do? Should you just sell all your stocks and give up? No, I wouldn't say that. But to get outsized returns, I think you need to be a stock picker. And yes, for many people, that's not something they want to do. They haven't got the time for it. So just go and buy an ETF and aim for 6, 7, 8% if you're lucky. That's a fair thing to do. But if you want more than that, yes, you need to understand it. You need to be a stock picker. If you want even more than that, I think you need to be a trader. I think this is a stock picker's market. I've said this before. I think this is a short-term trader's market because we have more visibility on the next week than we do on the next year or even the next 5 years. So there is money to be made there. Now, the way the Fed sums this article up, this research paper rather, it says, it may be tempting to assume that the exceptional stock market performance of the last 30 years will continue indefinitely. My analysis, however, indicates otherwise. So it's not going to happen. Both stock returns and corporate profit growth are very likely to be substantially lower in the future. So simply put, Why would you pay above average valuations for stocks when they are going to get below average growth? One reason I hear you saying AI, and yes, it's true. I think AI is going to improve profit margins because we can lay people off and we can replace those jobs. Not very much fun for the people getting laid off, but very much fun for the investors, the stock investors. That's the perverse world that we live in. So yes, I think that is a potential shift, but you need to then knuckle down on which stocks actually benefit from that, right? It's not all stocks equally. I made a video on that a little while ago. I'll try to link to it at the end of this one. Which stocks I think are actually most likely, this is based on data, to make the most money in savings from AI. So might be time to adjust the long-term investment strategy here. I think it might be a reasonable thing. So let me know what you make of that. I'd really appreciate that. I love that you smashed the subscribe button over 50,000 times. Thank you for that trust, and thank you for wanting to join this beautiful community of people who help each other get to financial freedom. That's really what this is all about. Thanks for watching.